Hey everyone, welcome back to Corporate Decoder, the place where we help you understand the hidden stories in company filings, especially when they involve extending loan agreements and possibly boosting their cash flow. Today we are diving into a filing from the Davey Expert Company, a business that has been around for a while and is now making some moves to manage its finances a bit differently. Essentially, Davey has updated one of its main loan agreements. This isn't something that happens every day, so it's worth looking into what it means for them and for anyone who cares about the company's financial health. This filing is a Form 8K, which is basically a report of big company events that shareholders need to know about right away. And the big event here is an amendment to a financing agreement. The core of this report is about an agreement called the Receivables Financing Agreement, or RFA for short. Think of this like a flexible loan system based on the money the company expects to collect from its customers. It's an accounts receivable securitization program, which is a way for companies to get cash faster by using their upcoming payments as collateral. So what's changed? Well, they've extended this financing agreement for another year. The original deadline was July 2025, and now it's good until July 17, 2026. This gives them more breathing room and stability for at least another year. More importantly, they've also increased the amount they can borrow under this program from the previous limit up to $17.5 million. That's a significant boost in their potential borrowing capacity, which could mean they are planning for growth or perhaps managing immediate cash needs. It's also interesting to note that a specific subsidiary, Davey Receivables LLC, is involved as the borrower. This is common in these types of deals as it isolates the receivables and the financing from the main company's balance sheet. It's a way to manage risk. On top of extending the main agreement, they also signed a joinder agreement. This means other subsidiaries will now also contribute their receivables to this program, making the pool of assets backing the financing even larger. This strengthens the overall facility and likely allows them to access that increased limit. Now, while this filing doesn't give us exact numbers like specific interest rates or the current amount drawn on the facility, it tells us the company feels confident enough in its future collections to secure more financing and extend existing arrangements. This section essentially reiterates that the company has entered into new borrowing arrangements. By increasing the credit line and extending the maturity date, they are creating a more robust financial framework for themselves. It's a proactive step in managing their liquidity and financing needs. There are no specific securities registered under Section 12B of the Act mentioned here, indicating that perhaps their main stock is not traded on a major exchange, or that this particular filing isn't directly about a new stock listing. The report is signed by Joseph R. Paul, Executive Vice President, Chief Financial Officer, and Assistant Secretary and Director. This is the person responsible for overseeing the company's financial health and decisions. The report itself was filed a few days after the agreement was signed, which is standard procedure for these kinds of disclosures. So what does this all mean for the Davey Expert Company? On the surface, it looks like a positive move. They are securing their financing for longer and increasing their access to funds up to $705 million. This suggests they have a good handle on their receivables and expect a steady flow of payments from their customers. Think about it this way. If you have a reliable stream of income, like monthly payments from many customers, you can borrow against that future income. This financing facility essentially turns those expected customer payments into ready cash for the company. This could be for anything from funding new projects, acquiring smaller competitors, or simply ensuring they have enough cash on hand to operate smoothly, especially if there are seasonal fluctuations in their business. Now, I don't have many intricate financial tables to dig into here, as this filing is more about the agreement itself rather than a full financial report. But the commitment from a large bank like PNC Bank National Association as the administrative agent lends credibility to the deal. This suggests that PNC Bank has thoroughly reviewed Davey's financial situation and their ability to repay any funds borrowed under this facility. The fact that they are increasing the facility limit to $175 million could signal an expectation of increased business volume or a strategic decision to have more financial flexibility. This gives them an advantage in potentially pursuing growth opportunities that might require significant upfront investment. However, it's also important to remember that having access to more debt is not the same as having more profit. This increased borrowing capacity comes with the obligation to repay with interest, so the company's ability to generate cash from operations will be crucial to servicing this debt. From a Warren Buffett perspective, we want to see a company that manages its debt prudently and uses borrowed money to generate returns that far exceed the cost of borrowing. If Davey is using this increased credit line to invest in profitable ventures that generate solid returns, then it's a smart move. If they are simply using it to cover operational shortfalls without a clear plan for profitable growth, then it could be a sign of underlying weakness. For Davey, this extension and increase in their securitization facility suggests a stable outlook for their accounts receivable, which is a good indicator for a company that likely relies on consistent cash flow from its services. The key takeaway is increased financial flexibility and a bolstered ability to access capital. Looking ahead, their primary challenge will be to utilize these funds effectively, generating returns that justify the cost of borrowing and ensuring they can comfortably manage the repayment obligations. This is a sign of maturity in their financial management, but like any debt, it needs to be managed wisely. So what's my take? Davey is taking a smart, proactive approach to managing its financial resources by extending and enhancing its receivables financing. This gives them stability and more options for the future. It signals confidence in their business model and their ability to collect payments from clients. What do you think about this move by Davey? Does it make you more confident about the company's future? Or do you have other concerns? Let us know in the comments below if you found this breakdown helpful. Please give this video a thumbs up and subscribe to Corporate Geocoder for more insights into company filings. And don't forget to join our Discord community linked in the description below for more discussions and to connect with fellow corporate finance enthusiasts. Thanks for watching. See you next time.